Hi, I'm Margot,
And I'm Christy.
and we wanted to just do a little recording of answers to some questions that we've been asked about the Access Manning deal.
Right. So, how confident are we that we will achieve our projected exit value?
We're pretty confident. We have a lot of time and a lot of room here for raising rates, adding units,
Right.
and we're going to be able to reach probably the exit operating income that we need to be at in year four, and
Right.
we're allowing for 5 years, so we should have no problem.
And also, because of the way that we structure our deals, our investors are paid a projected um, annualized return. So for our Class B investors, it's a 20% average annualized return. And to attain that valuation, we have a lot of flexibility in our income, our net operating income, and our cap rate, and all of the metrics that actually get us there. And time is definitely on our side.
What happens if rents cannot be increased as projected?
Our projection of rents is to get to about 5 or 10% of market, and that's of where market is today. We never project being the highest in the market, although this will be one of the nicer facilities in the
Yeah.
market once we do our CapEx and get everything taken care of. We still don't want to be one of the higher in the market. So that means that we do need to project some increases in rents, and we don't have to hit our actual targets actually, because again, as we said, we have a number of years in this deal, and we're not projecting to be at top of the market, but we do need to hit at least about 70% of the projections that we're projecting in order to exit our investors where we intend to exit them.
Right.
How much of the projected return depends on expansion?
Not very much. Most of the returns that we're talking about at this point in the deal are based on raising rents, adding some units, and some of that can just be parking, but
Right.
it's not based on the huge expansion. And also, if we don't do the expansion, if we decide it doesn't make sense, we won't need to raise as much money, and that's going to improve the returns for the investors as well.
Right, right. It definitely makes hitting the returns. If we raise less money, then it's easier for us to hit our target returns. Another question that has come up is, about our rate cap, our exit cap. And we did talk about this
Mhm.
in the presentation, that the cap rates can go to 10 to a 10 cap, 10%. And our investors still hit their target returns.
Right.
We don't make many, but our investors are still very much taken care of.
You are always paid first.
Right.
Yeah.
What is the break-even occupancy? We're currently at 70%, and break-even, which is covering all of the expenses and the mortgage payment, is at 60%. 60% occupancy or better, we're still doing good.
Yeah.
Getting below that, we can't pay our investors the projected distributions. So it is something that we are very cognizant of, but break-even occupancy is 60%. What specific operational changes will drive NOI growth?
Well, of course, price increases, as we've talked about, that is a biggie. Um, we also have an opportunity to bring in tenant
Protection.
protection, the word just went out of my head, tenant
Right.
protection, and the in-unit motion detectors.
Right.
These are income streams for us that don't exist there currently.
Right. This is not a deal where we're doing major expense reduction because it's being run extremely lean as it is. Actually, our expenses will increase
Yeah.
from what the seller is doing
Right.
because we feel it's not being managed very well. So our expenses actually will go up. I would also say that there are expenses that the seller is incurring that are not being
Reflected.
reported
It's all being
Right.
absorbed by their other
by their other
businesses, the management
businesses.
and admins of the other businesses.
Absolutely. So
Yeah.
the expenses currently being reported are low. So it's not even that our expenses are going up, it's that we will be more accurate about it.
Right.
Tenant turnover during the transition, how will that impact cash flow? This is always a
Yeah,
very
it's
important.
always a problem in the
Right.
beginning,
Right.
but we expect it. You know, we budget for that. We anticipate it.
Right. At the same time that we are making all of our improvements, we do lose some customers who are used to paying cash, are used to paying by check, because we don't allow either of those. In this particular case, there's very few
Yeah.
people who are used to paying cash. They do have some who bring a check into the office,
But not many.
Not many. Because of the way that they've been running the facility, they have a lot of people on auto pay, which is unusual
Yeah.
and fantastic
Yeah,
for us. They're
right.
used to seeing that money leave their account. Nothing is going to change
Yeah.
for them immediately. As a matter of fact, everything is going to get better for them very quickly. They're going
Yeah.
to have better access to customer
So
service.
this is going to go better than what we anticipated,
Right.
as far as that goes.
Right.
But
So-
there's also always a little bit of cleaning house. You know, we do have units that appear to be abandoned,
Right.
and we have not really that many that aren't paying.
Right. But that's
So
all in our current
it's all
vacancy
part of,
rate. It's
what we
accounted for.
expect. Yep.
Yeah.
So we will probably lose a few there, but again, we're
Mhm.
going to replace them with people that pay more.
Yes. Yes. What is the contingency if our CapEx costs exceed budget?
We can almost say that they really won't. I mean, obviously things happen, there are surprises. We always have a bigger contingency in the budget than what, we expect to spend. But the other thing is, because the things we do can happen in a short period of time, we have things under contract and know prices before we start.
Right.
So yes, you can have unexpected things that come up. They're not necessarily CapEx related directly, but they could come up during that time. But, before we start something, we're going to have a pretty good handle on what the actual cost will be. So the timeline for improvements and stabilization, well, in the first 3 months, we really are just kind of cleaning house, getting people so that they're paying the way we want them to pay. And like we said, that shouldn't be as big of a deal as usual.
Right.
We also will begin our CapEx. And I think we mentioned in the video, we're going to start with door repairs because there's a lot of door repairs needed before we paint. Usually painting is the first thing we do so that there's a big, woo, look how great the place looks. But this time we're going to get the doors fixed first because it's such a, so many of them are a problem or have problems.
Right.
And
the facility does not look too bad.
No.
The doors are weathered, but it's not like other facilities where doors were actually kind of different colors and different shades of colors.
And there's not as much, and there's not as many places where they've been dented and run into. I mean, there's a couple, but not like we usually see.
Which is surprising.
Yeah, it's surprising. So, overall, the buildings look better than you would expect. It just looks a little faded.
Right.
And, once we do get to painting, boy, that's going to make a big difference. And what is that saying? When should we be stabilized? Well, we expect all the CapEx to be completed in about 6 months. If we do the additional expansion, we're going to have to update you then. We still have to determine the full scope of that and how long that will take and permitting and all that.
So we should be stabilized in about a year.
Stabilized for sure in about a year.
Yeah. Without a doubt, this property should be stabilized within a year. And we already discussed the impact to our distributions, which won't begin until after the second quarter of ownership, second full quarter of ownership. What makes this deal resilient in a downturn? Well, that's what makes self-storage resilient in a downturn. Then there is one other thing that I want to bring up, which is not a question that we've been asked per se, but when you look at self-storage versus other asset classes, multifamily, for example, multifamily is great in a place where a population is really growing. Self-storage is just a very different animal. And for self-storage, let's say you have a population of 1,000 households. Um, and let's say it stays those same 1,000 households.
Mhm.
Certain things are going to happen. In a good economy, those same 1,000 households are going to buy more stuff and have no place to put the extra
Right.
stuff. So even though the population has not increased, there is still a need for self-storage. In that same, population, not increasing, 20-30% of those people get divorced over a certain number
Right.
of years, right? So
There are
now,
always deaths in the family.
right, so households split, death in the family, grandma passes. Where does her stuff go? Well, it goes into storage because you can't get rid of
Yep.
that, anything. You
Right.
can never get rid of anything.
A pipe bursts
A pipe,
and
oh,
you have to
this
move
is
everything into
right,
storage while the insurance
temporarily.
company gets everything fixed.
Right.
I mean, there are always these things that drive the need.
Self-storage
Yeah.
happens, self-storage exists because life
Stuff
happens,
happens.
period.
Life happens.
And so you don't
Mhm.
have to have a huge influx of population. The population here, it is increasing, but even if it goes sideways, even if the economy goes up or down, it almost doesn't matter with storage. Occupancies for storage remain
Very
constant.
stable.
All of these
Yeah.
things really offset. And when you have a facility like this one that we just purchased, you have the opportunity to make it one of the better facilities in the marketplace, which is great about a small marketplace.
Mhm.
There are no major brands here. Public Storage is not in the immediate area. None of the big boys are here in the immediate area. And a lot of the facilities look kind of like this one does currently. So when
Or worse.
or much, much worse.
Yeah.
With that, and they're not fenced, they're just not in a state that we would like to see
Mhm.
the facility in. So once we come in and do the improvements that we're planning, we're definitely going to be one of the nicer facilities in the market. Another question.
Why was this asset available at this price? Well, part of the reason is that the seller just didn't want to be doing self-storage. That's not
Right.
their thing. It was never their intention to do self-storage. They kind of fell into it sideways
Right.
and discovered that, boy, this really makes money. That's the only reason they grew it and added additional buildings. So, has it been mismanaged? Yeah, a bit. And they just weren't really doing all the things they could do. They weren't marketing. There wasn't a website.
Right.
They weren't, fixing things on a regular basis. So
What's also interesting about this deal is that the down payment required by the seller
Right.
was 10%,
10%.
which is another reason that we were able to,
Do this so
number
quickly.
one, move so quickly.
Mhm.
Number two, plan the type of CapEx impact that we're planning and still hit all the numbers that we're looking to
Yeah.
hit. The sellers, again, they didn't need the money.
Mhm.
They just are tired of dealing with this
Yep.
asset.
Yep.
It's
I know.
amazing,
Yeah.
right?
Yeah, they're just done. And,
Yes.
and obviously they'd rather have, some monthly cash flow,
Mhm.
so that's why we got seller financing. But yeah, as far as a big chunk, they didn't need
Right.
that.
Right. So if you have more questions, please email us, contact us. We're happy to answer them.
Yep. Thanks a lot.
Bye.
Bye.